What is RBI reverse repo rate? The reverse repo rate, like the repo rate, is a key tool used by the Reserve Bank of India, RBI, in its monetary policy operations. It is the interest rate at which the RBI borrows money from commercial banks or other financial institutions for the short term. Here is an explanation of the reverse repo rate and its significance. The reverse repo rate is the interest rate at which the RBI accepts money from banks and other financial institutions on a short-term basis. It is essentially the opposite of the repo rate. In a reverse repo transaction, banks lend money to the RBI by purchasing government securities or other eligible collateral, and the RBI agrees to repurchase these securities at a future date. Role in monetary policy. The reverse repo rate serves as a crucial tool in the RBI's monetary policy toolkit. It complements the repo rate and helps the central bank achieve its monetary policy objectives. Absorbing excess liquidity. One of the primary purposes of the reverse repo rate is to absorb excess liquidity from the banking system. When the RBI conducts reverse repo operations at a specific rate, it offers banks a safe and interest-bearing avenue to park their surplus funds. Banks prefer to invest in government securities or deposit funds with the RBI at the reverse repo rate when it is attractive, as it is risk-free and often provides a better return compared to lending in the interbank market. Influence on money market rates. The reverse repo rate also has an indirect impact on other short-term interest rates in the money market. When the RBI raises the reverse repo rate, it becomes more attractive for banks to deposit funds with the central bank rather than lending them in the interbank market. This can lead to an increase in short-term interest rates in the broader financial system. Balancing monetary policy. The reverse repo rate is used in conjunction with the repo rate to manage liquidity and influence overall economic conditions. If the RBI wants to tighten monetary policy and reduce liquidity in the banking system, it can raise the reverse repo rate. Conversely, if it wishes to inject liquidity and encourage borrowing, it can lower the reverse repo rate. Impact on banking and borrowing. Changes in the reverse repo rate can indirectly affect interest rates for consumers and businesses. If the reverse repo rate is raised significantly, it can lead to higher interest rates in the banking system, making borrowing more expensive for borrowers. Monitoring economic conditions. Like the repo rate, the reverse repo rate is reviewed and adjusted periodically by the RBI during its monetary policy meetings. The central bank assesses economic conditions and financial market dynamics to determine the appropriate level of the reverse repo rate. In summary, the reverse repo rate is a tool used by the RBI to absorb excess liquidity from the banking system, manage short-term interest rates, and influence overall monetary conditions in the Indian economy. It is a key component of the central bank's efforts to maintain price stability and promote economic growth.